Hey everybody, surprise, surprise, we are going to be talking dividend stocks. It's one of our favorite things to talk about on this channel. There are some great bargains at dividend stocks right now, mainly fueled by the interest rate environment and things like that. It's kind of created some bargains that lasted longer than we had initially thought. Before we dive in, Tyler Crowe is joining me. Please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. If you're looking for some ideas, it's a great place to go. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, in true Tyler fashion, we did a video recently where I pitched a stock that he wasn't that familiar with, but we're going to reverse our roles back again. Tyler's going to talk about a stock that a lot of people are not familiar with, that I am not that familiar with. So, what high dividend stock are you looking at right now?
Yeah, I may have done this one before, but I'm going to do it again. I tend to repeat myself a lot.
Hey,
Uh,
if you like it, you
I'm
like it.
exactly. I'm going to talk about Equinor. Used to be called Statoil. This is the Norwegian oil and integrated oil and gas giant, one of the largest oil and gas producers in the world. Also, um, just happens to be one of the largest suppliers of natural gas to Europe. Prior to the invasion of Ukraine, I think they had like 40%. I think it's more now. So it gives you an idea, like they're a kind of a critical supplier of critical energy in a kind of an energy starved part of the world, which, it makes a good hook. But, the thing that really like gets it for me with this company is it's just a really good operator. They're good at allocating capital. They have a very large, robust supply of low-cost oil and natural gas in the Norwegian continental shelf. They've been drilling in the Norwegian continental shelf, which is basically just offshore of Norway. They've been doing that since the 1970s. They continue to do it. They tend to get most. I think there is some sort of legal requirement when it comes to the offshore Norwegian shelf where Statoil has to be involved in Equinor has to be involved in some way, some fashion, either as a minority or an operator. So it can partner with people, but it still has to be involved. Um, it's a low cost source of oil that's going to last for a very long time. And as a result, you have high rates of return, which I think are going to last for quite a while longer. And it's a high return, still trading at a relatively low valuation. I just want to give an example here, and we'll do a comparison to a much more familiar company, right? ExxonMobil. Currently, ExxonMobil has a return on equity, so kind of a proxy for how good it is at making a return on what it does. Has a return on equity of 14% and trades at 13 times earnings and has a dividend yield of about 3.7%. Now, what's going to compare that to Equinor, which today has a return on equity of 20% and for the past 4 years has had returns on equity well above 20%, while at the same time having a trailing price to earnings ratio of 7.7 and a current dividend yield, based on its current the most recent payout of about 6%. It was paying a special dividend for the past couple of years because it has been basically having bumper energy prices across Europe, and it over the past 12 months, it's been paying special dividends that have yielded closer to 10%. But it said that it's going to start focusing a lot of that back towards buybacks because, again, when your stock trades for 7 times earnings, buying back stock's a pretty good idea. With that in mind, another thing I just want to mention too is it's a thing called the shareholder yield. It's a combination of the dividend that you get from the company, the buyback that it does over like 12 months, and then debt pay down, so increasing the equity stake you have in the total capital stack. As of right now, Equinor has a shareholder yield of about 17%. Now, if I'm going to get an annualized return of 17% just on dividends, buybacks, and debt pay down, that's a pretty good trade. I think this is a company that trades for extremely cheap, and probably because it isn't the namesake that you hear when it comes to oil and gas. It's not ExxonMobil, Chevron, Shell, BP, or like retail names that we're accustomed to in the United States, but an extremely well-run business, low-cost oil supply. should also mention it does have significant investments in renewable, and it's actually been good at investing in renewable. Most oil and gas companies stink at it, but they've somehow managed to do it well. And so I think all of these things combined, it looks great. Yes, it's going to swing up and down with oil prices, but that's kind of the price you pay when you invest in commodities.
All right, I'm going to keep mine kind of quick. This is Vici Properties. It's one that I definitely have talked about before. And there are some really interesting opportunities in real estate right now. I mean, the interest rate environment has created like a lot of underperforming. It's actually the worst performing sector in the market over the past 2 years running. Just to look at Vici, it actually was an outperformer throughout the first part of the interest rate cycle. One of the very few real estate investment trusts that was up in 2022. Granted, it was by 8%, but this is when the S&P was in a total bear market and everything was falling. Rates were rising and a lot of real estate stocks were down. They were doing well. There's a good reason for that, which I'll get to in a minute. But since that time, they were down by 2% in 2023, 8% in 2024. So when you look at those the past 2 full years, the S&P 500, including dividends, was up about 50% over the past 2 years, close to it. And Vici was down by about 10%. This is after a multi-year streak of outperformance in the real estate sector. So 60 percentage points of underperformance versus the S&P. The biggest reason is interest rates and what they do for real estate companies. Not only are, and I've explained this before in other videos, not only do higher interest rates make it more difficult to borrow money to finance properties, but they also make commercial real estate less valuable with something called cap rate expansion. In other words, unlike when you buy a residential home, like if Tyler and I were to go buy a home, the price we pay is supply and demand. That's really what it is. That's why different markets and different neighborhoods and different features command different prices. With commercial real estate, it's all about how much rental income it can generate.
It's fine, Matt. You can say residential real estate is an irrational product.
It absolutely is. Commercial real estate, believe it or not, is very rationally priced. It's priced in a given market based on how much rent it can generate and the current yield expectations of investors. For example, a 7% cap rate means that if you were to buy a property for $1 million cash, you would expect its net income in the first year to be about $70,000, so 7% of that. Since yield and price have an inverse relationship, as cap rates rise, which they do when the interest rate environment rises, because investors expect higher returns on their yield, then the price investors are willing to pay for commercial real estate falls. Not that the business itself is doing bad. Vici's business is actually doing quite well. And most other real estate investment trusts that we follow are doing really well business-wise. But just because of the interest rate environment, property values are down. And I mean, it's not terribly surprising. Interest rates were kept, let's just say, artificially low for quite some time. We saw cap rates in the 3% range in certain parts of real estate, which is kind of unheard of historically. So, how much was a normalization and how much was an actual effect of the Fed's moves? But there are some good reasons to like Vici. If you're not familiar, they're a casino real estate company for the most part. They are the biggest property owner on the Las Vegas Strip. They own the real estate, not the business, of Caesar's Palace, the Venetian, MGM Grand, Mandalay Bay. There's a bunch on the list. They own a bunch of regional gaming assets, a lot under the MGM brand name and the Caesars, various Caesars properties. But they do have other tenants, and they've done a really great job of expanding. They were originally a spinoff from Caesars. They eventually acquired their MGM spinoff rival called MGM Growth Properties. That's why they have so many MGM properties. But one of the things I like about them, unlike a lot of real estate investment trusts that just kind of grow for the sake of growing, they grow in a way that actually builds their earnings, that's accretive to earnings immediately. When they acquired MGM Growth Properties, they roughly doubled the size of their business overnight. But on a per share basis, we saw their earnings continue to rise, which doesn't always happen. I forget which industrial real estate investment trust it is that Tyler and I have talked about a few times. Is it Stag maybe? That has just continues to raise capital and buy properties, but doesn't really grow its earnings.
Yeah. Yep.
V,
That's the one.
Vici's not that company. They've made two major acquisitions, I would say, in MGM Growth Properties and the Venetian Resort, both of which have been immediately accretive to earnings. They are starting to branch out from casinos into other types of experiential properties. They acquired a portfolio of Bolero properties. I think it was 38 different properties. Still very small in scale compared to Caesar's Palace in Las Vegas. But it's a nice first step toward diversifying the portfolio. They want to do more of that. Their gaming leases are all 50 years or more. They are almost all, I think 95% of them have rent payments that are linked to the CPI, so they're inflation protected. Very high asset quality. These are not like hole in the wall casinos. These are very impressive properties. A lot of long term opportunities, and just I think they've only been public for 8 years. They have a really strong history of executing in just that 8-year time period, despite what their recent stock price said. With a 6% dividend yield, I think this is a buy today. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.